In the final months of the Civil War, Union Army chaplains and civilian missionaries working alongside freed people observed a practical problem. Thousands of Black soldiers and civilians had accumulated wages, enlistment bounties, and small savings, and had no secure institution to hold them. Some deposited cash with Army paymasters. Others kept it in whatever safekeeping they could arrange. Northern reformers concluded that what this new population needed was a dedicated savings institution, one that would give freed people a protected place to build resources and, in the language of the era, practice the habits of thrift and economic independence. That idea became the Freedman Savings and Trust Company. On March 3, 1865, in the closing hours of the 38th Congress, legislators passed two significant pieces of legislation on the same day. One established the Bureau of Refugees, Freedmen, and Abandoned Lands, known as the Freedmen's Bureau. The second chartered the Freedman Savings and Trust Company as a private nonprofit corporation. The two laws were legally distinct, and the bank had no formal tie to the federal government or the Bureau. But the shared political moment, the government-adjacent name, and the patriotic imagery printed on the bank's passbooks created a powerful public impression. Many depositors, some literate and some not, understood the institution to carry the guarantee of the United States government. That impression was incorrect, and its persistence would matter when the bank came under pressure. The original charter was deliberately conservative. All deposits were to be invested in United States government bonds, the most creditworthy securities available. This restriction prevented the bank from chasing higher returns, but it also meant that whatever depositors entrusted to the institution sat behind the credit of the federal government through those bond holdings. In the early years, the model worked. Branches opened in major cities with significant Black populations, including Charleston, New Orleans, Washington, Richmond, Norfolk, and Savannah, among others. Black churches deposited their collections. Fraternal organizations and mutual aid societies opened accounts. Soldiers deposited bounties received on enlistment. By the late 1860s, the bank had grown to 37 branches, according to historical accounts compiled from its own records, and appeared to be one of the more durable financial institutions of the Reconstruction period. In 1870, Congress amended the bank's charter. The revision permitted up to half of all deposits to be placed in loans secured by real estate or other collateral rather than restricted to government bonds. Supporters argued that this would generate higher returns for depositors and allow the bank to do more good for the communities it served. What the amendment did structurally was convert the institution from a narrow bond investment vehicle into a discretionary lender. Discretionary lending requires sound judgment about borrower creditworthiness, rigorous evaluation of collateral, and governance arrangements that separate the interests of the people approving loans from the interests of those receiving them. Whether those conditions were met at the Freedmen's Bank would become the central question when examiners eventually reviewed the books. The bank was governed by a board of trustees drawn from Washington's business and civic community. Among them was Henry D. Cook, a Washington financier and the brother of Jay Cook, the Philadelphia banker whose firm had served as the dominant underwriter of United States war bonds during the Civil War. Historians have documented that Henry Cook held positions in the bank that put him simultaneously in the role of an overseer of lending and as a party with extensive interests in Washington's real estate market, the same market the bank's amended charter now allowed it to finance. A government review of the bank's accounts in the early 1870s found that loans had been extended to parties with relationships to board members, according to historical analyses of the period's records. Whether this constituted fraud in the legal sense was disputed at the time and remains a matter of historical interpretation. What is documented is that the quality of the loan portfolio deteriorated in the years following the 1870 amendment. On September 18, 1873, J. Cook & Company, the nation's most prominent banking house, failed. Cook had overextended his firm, financing the Northern Pacific Railroad, and could not meet his obligations when credit markets tightened. The collapse was immediate and dramatic. The New York Stock Exchange suspended trading for 10 days, an extraordinary closure at the time. Credit contracted across the economy, and a prolonged depression followed that lasted several years. Freedman's Bank branches felt the pressure almost at once. Depositors who heard of bank failures nationwide sought to withdraw their savings. The bank, which by then held a large share of its assets in illiquid real estate loans rather than marketable government bonds, could not readily convert those assets to cash to meet the demand. By early 1874, the bank's leadership recognized that the institution needed a figure of unimpeachable public trust to restore depositor confidence. In March of that year, the board appointed Frederick Douglass, the most prominent Black public intellectual in the United States, as the bank's president. Douglass believed in the mission the institution was supposed to serve. According to accounts preserved in historical biographies and his own later writings, he invested a substantial sum from his personal funds, with historians most commonly citing approximately $10,000, though this figure has not been confirmed from a single verifiable primary source document. He moved into the bank's Washington offices and began examining the accounts. What those accounts revealed changed his view of the institution entirely. As Douglas examined the loan portfolio, the picture was damaging. A significant portion of the loans were impaired, borrowers were not paying, and the collateral behind many obligations was worth less than the amounts outstanding. The bank's assets, even at the most favorable realistic valuations, fell short of what it owed to depositors. In subsequent accounts of the experience, Douglas described discovering that the institution was sound in name, but broken underneath, though the precise wording of his descriptions varies across the secondary sources that recorded his observations. He appealed to Congress to provide a federal guarantee of deposits, arguing that the government's decade-long association with the bank had created a reasonable public impression of federal backing, and that the government bore at least a moral, if not a legal, obligation to make depositors whole. Congress declined, citing the bank's private corporate status. On June 29, 1874, the Freedman Savings and Trust Company suspended operations. At closure, the bank owed approximately $3 million to roughly 61,000 depositors, figures cited in historical accounts and in the congressional investigations of the period. Those depositors included individual freed people, Black churches, fraternal organizations, and civic groups that had trusted the institution over years. Congress placed the bank's affairs in the hands of 3 commissioners charged with liquidating assets and distributing whatever remained to creditors. Frederick Douglass resigned the presidency as the closure was finalized. The institution that had been presented as a vehicle for economic inclusion had become another failed promise of the Reconstruction era. The receivership process lasted years. Commissioners sold assets, collected on performing loans where they could, and paid out dividends to depositors across multiple distributions. Historical estimates of the total recovery rate vary considerably across sources, with some accounts suggesting depositors eventually recovered roughly half to 2/3 of their balances over the following decade, while others placed the figure lower, particularly for smaller depositors who lacked the resources or legal standing to navigate a prolonged claims process. Congress considered but did not pass measures to compensate depositors more fully during the 19th century. In 2022, Congress passed legislation formally acknowledging the harm caused by the bank's collapse, though direct financial restitution to descendants remained limited. For most of the original depositors, the loss was permanent within their own lifetimes. The Freedman's Bank collapse did not only erase balances on a ledger. Historians and economists who have studied the episode have argued that the failure contributed to measurable and lasting distrust of formal financial institutions among Black Americans. Some researchers examining county-level data on banking participation in later decades have found correlations between proximity to former Freedman's Bank branch locations and lower rates of banking engagement across subsequent generations, suggesting the effect extended beyond the immediate depositor population. Historians are careful to note, however, that the bank's collapse was one among many legal and economic exclusions of the post-Reconstruction era, and isolating its specific contribution to long-run wealth gaps is contested in the academic literature. The episode is nonetheless consistently cited as a formative moment in the relationship between Black communities and the American financial system. Every bank deposit in the United States today, up to $250,000 per depositor per institution, is insured by the Federal Deposit Insurance Corporation, which Congress established in 1933 after thousands of bank failures during the Great Depression swept away the savings of ordinary Americans. The FDIC has publicly recognized the Freedman's Bank as part of the history that illustrates why deposit protection matters, naming programs and forums in its honor. The structural lesson the Freedman's Bank carries is straightforward. The legal character of a financial institution matters independently of its founding purpose, its name, the public figures associated with it, or the intentions of those who created it. A bank that appears government adjacent is not the same as a bank that is government backed. A savings institution founded on the best intentions can still fail if its governance and investment rules break down. What protects depositors is not confidence in an institution, but the legal framework built around it. The deposit insurance system is the answer the country eventually arrived at, and it took nearly 60 more years of failures to get there.